And good afternoon. This is Dan with your weekly review and outlook, episode number 5 here, brought to you by Derivative Technical Analysis Program here at Van Ahn & Company. Pretty exciting week here across the board, I would say, just with some of the volatility starting to pick back up. Obviously, ranges on a few products have stayed somewhat minimal, but volatility is starting to come back here a little bit with at least some of these outside markets that we take a peek at. So it should shape up to be a pretty interesting end to the week here. And then, coming into next week, kind of wrapping up August here, coming into next week, we kind of start September, middle of next week. So we have a lot of things coming at us here. You'll see in this update just some nice economic things coming to us here over the next week or so. And obviously just with the coming in towards the end of the summer, we should kind of expect that volatility to kind of start here for us. Before I get any further, I do want to start off with past performance is not indicative of future results. Futures and options trading involves risk of loss and is not suitable for all producers and/or investors. This is a solicitation. Now that we have that out of the way here, we'll go to our outline here. Again, kind of just touching on the importance of the economic calendar here coming forward over the next week to couple weeks. I'll kind of cover that as we get into the show here, but technical quick sheet update as well for you. Then we'll head into touching on the financial markets first with treasury bonds. Then we'll hit KC wheat and grains. Then we'll hit October live cattle in the meat market. Energies, will hit that crude oil market, and then finish up with metals and touch on gold here. A couple of these markets, or most of these markets, I will touch on, the contextual overview. If you recall, kind of the objective of these weekly reviews and outlooks is more of a contextual view, broad thinking, weekly charts, longer term charts, where are we at relative to where we've been and where we think we could possibly have range to, and then kind of bring it down into the daily chart and smaller time frame charts to start kind of developing more of a executionable, thesis and scenarios that we can, develop risk reward scenarios that favor us overall. So with that here, we will go into our economic calendar here coming in, and just the last couple days here of August, obviously with tomorrow being the last kind of full week of August trade, but we do have a couple days next week of August. But coming in, let me just see here for the 30th next week here with U.S. pending home sales at 9 o'clock Central Time, Fed manufacturing survey at 9:30, export inspections, of course, every Monday at that 10 o'clock time frame. And then 6-month bill auction here at 10:30 as well as 3-month, and then crop progress report at 3 o'clock in the afternoon here. A couple other outside numbers from different countries that are also coming in here. Some European economic sentiment here earlier in the morning on Monday, and then some Japanese unemployment rates as well as industrial production. The big one here too, coming in on Tuesday, we get a lot of different GDP numbers, obviously with it being the end of the month on the 31st next Tuesday. We will have some more end of the month type numbers. So we have Redbook, House Price Index, Case-Shiller Home Price Index, Chicago PMI, Consumer Confidence Index, U.S. farm prices, all lined up on Tuesday. So Tuesday is a pretty big day. I will touch on, before I go any further into September, tomorrow also starts and marks the beginning of the Jackson Hole meetings with the Federal Reserve Committee here. So keep that in mind for tomorrow. That's going to have a pretty big implication on just kind of where these outside markets want to trade here tomorrow. could certainly bring some intraday volatility to these markets if they don't like what they're hearing or do like what they're hearing from Fed Chair Powell and the rest of the committee here. But all eyes, at least on the outside markets here, a lot of eyes will be focused on kind of that Jackson Hole meeting that again starts tomorrow and the rhetoric that comes out of that. Otherwise, stepping back into next week here, obviously Wednesday, Thursday, we do see jobless claims, productivity and costs, kind of the beginning of the month type reports, ADP unemployment, manufacturing index, construction spending, some more 3-month, 4-month, 6-month bill auctions that take place. We also have money supply there on Thursday. And then coming into Friday, pretty quiet on Friday. I mean, really just the U.S. unemployment situation on Friday that kind of wraps up Friday in terms of reports and bigger reports that we want to be paying attention to. From there, we'll go into the quick sheet here. With the quick sheet for the week, we did have a couple trades bouncing back and forth here. The big one here that we really had on from Monday, we did get stopped out of that here today, was this live cattle long trade. Put it on at 130.62.5. We were stopped at 129.50 here today. That was adjusted from the gap, the bottom of the gap here that we noticed on Monday. So did not quite get the extension that we were hoping for and planning for here in this market for live cattle. Off of that Monday's kind of trigger gap higher and go. Probabilities were certainly in our favor, I would say, as we kind of look at our notes, look at our process and whatnot, but just could not see the continued favor here in this market. I'm going to talk about in the meat complex here. I'm going to talk about this live cattle trade on the chart, so I don't want to drill it home too much because I'll touch it a little bit later here and just kind of show you what's going on from a weekly perspective and what could potentially be coming in for tomorrow. But we are stopped out at that 129.50 zone, and just really controlling that risk is the main objective. We had the entry that we liked. We had even really very good follow through, but just to defend 129.50 we thought was very important in this situation, and being that we were trading back through it. That's really our risk level that we decide to say, hey, this trade did not give us the follow through that we're able to see or want to see. Now we want to be back on the sidelines for the time being. Still working the strangle here in hogs. Very close to getting this off for 50% each side here. So keep that in mind. We're almost came close here today actually. So just kind of keep that in mind for you going through. That should, fingers crossed, kind of come off either tomorrow or into next week, just as we get more decay out of those options. Otherwise, as always, if you have questions on our posture levels, a lot of good posture levels that even we wish we could be trading. It's just we can't recommend and can't be trading everything all at once. So we kind of have to sift through these and kind of try to pick the best ones we believe, but really try to lean on these long short ideas that we provide. We do believe those are going to be kind of your best opportunities for finding ideas and finding levels to execute on, or at least look for per contract, where we would like to execute on per that position and per that contract. So as always, if you have questions on that, do not hesitate to reach out and ask. With that, we'll get into the chart. I always call it like the chart book portion of the update here. We're going to start with the Treasury bond market here and go out to that 10-year weekly perspective, so that bigger contextual view. Really the big thing I want to point out here before we move on to a smaller time frame is really just look at the last few weeks that we've settled in, to this range that was really shut off here a couple weeks back. And again, 1, 2, 3, we've been in this range now for about 6 weeks from high to low. The smaller time frame range from 167.04 to 162.16, and basically chopping back and forth in there. And now the overall bigger term view of this would be more of that counter trend trade higher from this move lower here. Now, what could offset this from being a more of a counter trend thought to more of a new trend type of thought is that we have RSI measures below 30 here, so the trend in our perspective is to the downside. To the downside here in both RSI and price. But we're seeing this counter trend rally that we've seen the last few months higher, of course, and that's where we see RSI trade into this 50 to 60 zone. If this does end up capping off here, which we do have, decent levels for and reasoning for sellers to kind of start showing up here and counteract those buyers that have showed up. This would then create more of a rolling over effect to the downside here. Below 162 certainly opens up the momentum or continued momentum to the downside in our perspective from that weekly view. If we end up sitting in this zone, we could end up just chopping in this 167 to 162 zone here and just building out this profile until we gain momentum to either side again. So keep that in mind. You're certainly seeing some bigger volume come in this week. As I kind of will allude on a lot of these contracts and just the time of the year, we're kind of wrapping up the end of the summer. A lot of the East Coasters are starting to come back from their vacations here in August, and usually you start to see that volatility and that those bigger markets start to move again. And that'll go along with a lot of these contracts across the board. So keep that in mind here, just as we see volumes and volatility pick up here in this contract. Coming down into the daily perspective here, again, just kind of emphasizing the kind of this top end of the range and this bottom end of the range that we're in, again, marked by our reference 1 to the upside and reference 1 to the downside. That is where our near-term values are located. So far, you could be playing the edges on this back and forth towards the middle or towards the other side. You do have that high volume node here towards the top side, just above 165, almost into 166. That is also of reference in more of that shorter time frame here. But again, you start to break down or break out above 167, and you have higher volume nodes above 168.30 reference node that we want to look at, and then obviously below 162. You're back below some pretty key moving averages at that point, and you have the volume point of control down around 156. That certainly would give some pull and some magnetic force to price here. But again, this consolidation so far, in our opinion, should be looked at in the very short term as actually very constructive, very positive for Treasury bonds. However, we need to see longer term RSI get above that 70 plus zone, and then also we just need 162 to continue holding and be in support, and you have some good levels to control against for risk at that point. That'll wrap up Treasury bonds here. Next chart I want to get into is this KC wheat market here, and they did just roll. They did roll out to the D's here. We'll touch. Obviously, we're using the continuous contract here, but just kind of noting that for execution wise. Again, just looking at the longer term view of this, these highs, these recent highs, are certainly something that you'd expect to see sellers show up in to some degree. These highs here from that April-May time frame, and then obviously the highs we've seen 2-3 weeks ago here, and then of course back in 2014 some of the selling pressure that showed up. Obviously we're not to the 850 highs yet, at least we very well could be, but there's not a lot of time from history that we've seen this market just stick around up here, above 750. It doesn't last very long. So in our perspective, just something to kind of be aware of contextually in this chart here, that if you start to see that exhaustion, kind of you pump higher with price and you fade right away, and you do that a couple times, that really starts to point out buyers are just having a hard time pushing this thing, from that longer term view. So we'll keep an eye on that. Obviously 739, 740 level is that upside reference one zone that we kind of be watching pretty closely there for more of a breakout at that point. However, I will say keep it short and sweet. I think at least for where we're at right now, we have very defined levels to go against and to trade against in the short term, and that is, even to the long side and possibly the short side. So kind of be ready for either here. But this higher volume node that we're building out, right around that $7 level, 702 is our downside reference one zone. This is something that you can really play off of. Notice how we settled in here around the 21-day EMA. They tried to push it lower, but each time they kind of brought it back up. Not really the best reversal closes or candles necessarily, but still, noting that, big volume node, 21-day EMA, they're trying to hold it in here. That's a good level to start managing risk against to try and play towards the top side. Now, I think expectations, this is where it comes in. Expectations really should be to test these recent highs, 750 to 756, even 745, 740 would be another key zone that really you could start to target for your first kind of target, if you will. And then above that would be that 768 zone. I think you have to we're to that point where you have to keep it short and sweet in terms of expectations. And that also means is that you might want to be more aggressive on, if you're a stop type of person or you like to utilize stops, start to get aggressive on your stops as you get into these zones. If you were to get into 740 or higher, it's probably a good idea to get those stops very tight and not as loose, if you want to say, and really try to capture that move or that profit if we do see that. RSI holding in very nicely here down below. If they shoot this thing higher over the next week or so, you got to imagine even a few days, and let's say we make new closing highs. I don't know if RSI is going to have enough time in there to really go take out a 70 plus reading. We'll see. In which case, again, we're talking about a momentum issue at that point. So that's really kind of the next scenario thought process. And another reason why we want to keep stops pretty aggressively tight here, both from a contextual standpoint and just from a momentum and trend standpoint on a shorter time frame. Those would be kind of those key reasons why. Again, if you have questions on that, love to talk through, again, that bigger contextual view. I think that's kind of the biggest point I wanted to bring out here is that contextually, Casey, we're up at those lofty levels. You don't see a lot of time or a lot of trade, like I said, above 750. And if you do, it's pretty quick. That doesn't mean you can't develop and start to kind of build out trades that can benefit more to the top side and more long trades. You just have to make sure that the execution and the expectation, more importantly, is in line with kind of that bigger contextual view, and see how the cards fall after that, if you will. Next chart we'll get into is that live cattle trade here. And I'm going to start with the daily chart here just to kind of explain and go back through just the overall trade here. So, and then we'll get out to the weekly because I think the weekly's starting to form something very important for a longer term situation. So coming in, Monday, we had, first of all, this very good consolidation going in. So a break to either side was something that we were willing to participate in. We came in Monday, you had a gap higher right off the gate, and it still gave you the ability to get in that first part of the morning. So, following that, I think that's what really gave it the momentum and the push is that you had a lot of traders, start to see that and push that thing higher, nearly $2-3, if I'm not mistaken, on pretty good volume too. So you're coming in Monday thinking, hey, we have a pretty good trade going here. Let's see if we can get some follow through. You start to put some extension counts in this thing to see if we can really start to plan this trade out from a target perspective. And really a logical place would be the 161.8% extension around 133.95, 134 zone. Did not quite see that, obviously, high at 132.85 where we started to fail at. At that point, we're really thinking, okay, maybe we have to consolidate around up here a couple days before we get another push higher. For the last 3 days, as you've seen, they shot it straight back down on declining volume. So that's one thing that we were watching throughout this process of, are we getting aggressive selling coming in, and we've seen decreasing volume the whole time through. So again, we're willing to keep that stop there at the low of that entry day. Our risk was well defined in this position, as we were willing to see and wait it out to see if we could get that consolidation or that follow through, to see if we can establish a better low, a higher low, that we could defend against, and see if this thing would trend higher for us over the coming days and weeks ahead. Obviously, that was not the case here, but I just wanted to kind of give you that thought process of what we're thinking here on this breakout, and just the management side of it. Not seeing the follow through that we wanted. Keeping the stop where is really our last line of defense for us, or our only line of defense for us that really made sense, without getting too close and just kind of picking random numbers. Is really kind of we're very process orientated in that, and trying to really ride out trends if they establish and if they allow us to. This one obviously did not. It was kind of a one day hit for us, and for the market in general. So we'll take this one. We'll put it in the bank as a loss, and we'll learn from that going forward here. Going to the weekly perspective is, I think, where this gets really interesting. I'm going to show this individual contract, and then I'll get into the actual continuous chart. But notice just kind of what we have going here, from a weekly perspective. Very, as you would expect, get the push higher and then fade. If this candle closes anywhere like this, similar, where it has this tail and fail type of mentality, reverse doji type situation, or reverse hammer type situation on what looks to be, good volume, this is not going to be something we're going to be, wanting to hold long into anyway at the end of this. So that is another reason why we want to keep stops tight. If they do reverse course and end up showing us something like this, it's not going to be something we want to hold on to. This is more of an exhaustive type of candle from our perspective and our rules. So that's not something we want to hold long into in this type of environment, where if we're starting to fail on breakouts and then print more of a reversal candle like this on the weekly perspective, if anything, we could very well be looking short coming into next week, assuming that this holds. And just to give an extra weekly look at this, it also shows on the continuous chart here as well, just that, I get that, there we go, just that reversal, that tail coming in. Again, it's Thursday today, so we have one more day in the week on this contract. So if we rally tomorrow and we don't print this, that'll be something that we take note of. But again, one day left to see if they can recover this candle right now currently. And again, if we print a candle like this where it's more of a reversal, rotations back lower towards that 125, 120 zone, kind of where we started to make this move, is certainly possible. And obviously we all know how quickly this cattle market can move. So keep that in mind. It's as of right now, Thursday afternoon, markets are closed, one day left in the week. This is something that we'll certainly be looking into tomorrow, and seeing if they do close this on the lows for the week, because that is, in our opinion, in our mind, shut off, from this recent move higher, and lower rotations to the downside become very, very much a higher probability in our view, and something we'll be looking to trade going forward. And the next chart here, we'll go into the energy market, and we'll start with that weekly perspective, or that weekly view here. Let's see if I can get it zoomed in for us. There we go. So we had a pretty bad close coming in last week. Closing at the lows, as you can see on the chart, and then really this week it's just been a straight shot higher. You started to get very exhaustive on the daily levels, daily charts that I'll show here in a little bit. But I think it just goes to show kind of how much of a big range this market potentially really is. You have a micro range or a smaller range, I should say, from about $66 all the way to about $75, 76, so a $10 range there, let's call it. And then add another probably $5 to $7 onto that to extend to a bigger range of about $15 to $17 using the $60 lows here on this front month chart. So you have two ranges to really contextually visualize here. Again, this is the bottom end of the bigger zone around that $60 range. This is the bottom end of the smaller zone around that $66 range, and then obviously the upper end of the zone around 75, 76. That is longer term breakout zone, longer term inflection point that has proven to be hold so far for 3 different inflection points. So, and as of right now, in the bigger range, we're stuck right in the middle. In the smaller range, we are stuck towards the bottom end of that, thanks to the trade that has occurred this week thus far. We'll see if it comes in and finishes out the week strong into tomorrow, but that's what we're dealing with right now from a contextual standpoint. If I go down and bring us to a shorter term daily view here, you do have, and you can start to see, that drive off the lows here the last few days, really since Monday. You had the 200-day EMA touch here, a nice reversal. Really, you came in and you had, with the 200-day EMA, you also had that support zone here back from the May timeframe. So that started to begin if you're a shorter term trader, this was a great zone. And we missed it, but a great zone to start putting some risk on in. You were down 6-7 days in a row here. I know some of the guys, some of our clients, we were able to reach out towards and kind of express interest in trying to get long. Some caught it, some didn't, but overall as a company, we obviously did not get it. This rally off the lows, something that when we look back on, more likely than not gonna say, hey, we should have had that as a company going. So something, again, we'll continue to kind of use that fail forward approach, but certainly a nice inflection zone, nice trigger there in that crude oil market. Again, you're not looking. I think the bigger thing too is you're not looking to really hit the ball out of the park with this type of trade either. It just got into a zone that looked very good from a risk perspective. As you can see also, RSI measured below 30 here. So you're not looking for a trend continuation trade here to the top side. It really is just more of a counter trend type of move here off of that 200-day EMA. To really even bring us in, your first target would have been achieved on day one. The last few days would have really been just bonus if you're still able to be in or adjust stops. And as of right now, we're really, again, as I mentioned previously, you're really just stuck in the middle now. I don't know if I'd be one to really just stick my neck out to either direction, quite honestly. You could certainly try to trade this higher to get to the higher end of that 75, 76 range. You could try to roll this thing back over as well. In my opinion, you kind of wait to see what this next move is. If we start to consolidate a few more days, then I think we'll be able to have some defined risk levels of breakdown zones on a shorter time frame. You can already start to see it on the last 2 days of trade, just with these smaller zones, smaller zone of highs and lows coming in. So that'll be something that we watch for. But if this consolidates here for a couple days, now you start to build out more of a consolidated zone that we can now trade off of and feel a little bit more comfortable, either expressing long interest on a break higher or expressing short interest on a break lower. Otherwise, we're just kind of guessing at this point in time, which direction we really believe this is going. But again, There's still more levels in here that you could still play off if you want to. I mean, the 69.5 level is certainly something that the bulls want to see, crude oil get back above. To the downside, if you take out these recent lows, that's going to be something that shorts really want to see, down in that lower 66s is kind of that support zone though. So if you are short, you want to keep things tight and probably target the lower 66 zone, because if you are short here, you're coming into this big volume node again where we just kind of rallied out of. So keep that in mind. Really, keep if you're on the short side, keep risk pretty tight in our recommendation on that point. But if you have to do anything, I would just say just wait and see if we can consolidate this out and get clear direction and a better directive here over the next coming days. And with the last chart we'll go over here, we'll go into, excuse me, not crude, we just did that, gold market. Talk about gold here on the long-term perspective. Very much I'll kind of reiterate what we've talked about. It's very much a mess in this gold market still. Again, contextually, if you kind of remember from a few weeks past, it's been this lower end of the range and then this higher end of the range. And obviously, anything in between that is going to be pretty messy contextually wise. Obviously there's going to be ways to make money from a move off the lows and then a move off the highs here back towards the middle or to the end of the range. But just from a contextual standpoint, you're going from a one big move here back from what started in late 2018 into 19 and into 20, now into 21. We've basically just sat and consolidated this thing sideways. So that's really the long-term contextual view we have going on here. Now, if we bring this down to the daily perspective, we kind of see that same thing going on, but we can start to execute and start to build, smaller narratives within the bigger context here. So 1730 looks to be pretty good support here for us. If we get a trade back down into there, rotating that back higher for a trade higher would be something we'd be looking into, very much similar to what occurred here in kind of this 2 to 3 day. Would you consider it more flash crashy in that environment? Now up towards the top end here, 1800 to 1815, you start to get pretty lofty and sellers start to kind of control the zone here a little bit. Even with the VPOC up here at 1881 and a half, you're really just entering the mess here in the middle of the broader range, and that's where I think it gets really hard to pick a direction here. You're probably better off, being more longer term positions being more neutral option positions, and then short term really just play the edges like I talked about back to the other side. So again, in this perspective, 1815, 1800 level, we'd be looking for more of that short trade here to focus us and to trade us back lower, below 1778 into 1750, etc. If we're back into 1730, we'd be looking to offset those shorts and rotate it and try to look for longs to rotate back higher into 1790, 1800, 1815, etc. And that's really the name of the game here, I think, and we think in gold right now. Obviously, the neutral positions create a little bit less need for hand holding every day. It's just more or less you kind of let the position decay that premium, that theta decay that we talk about in those neutral option positions, and see really this and watch this thing kind of just trade sideways for the most part until we get more information and really more time in our hands is what we mean by that. That's really the contextual and the execution recommendations that we want to be in. So sold strangles are going to be probably your best friend in this market, or again directional plays off of those extremes, those extreme edges that we talked about, back to the middle, back to the other end, and same thing from the top side. That'll kind of wrap up gold here for us and really wrap up the presentation as a whole here. I will close here with a disclaimer. Past performance is not indicative of future results. Futures and options trading involves risk of loss and is not suitable for all producers and/or investors. This is a solicitation. Have a great afternoon, everybody. If you're watching this here Thursday afternoon into Thursday night, and as well, have a great weekend for everybody. If you're watching this over the weekend, stay safe out there. And like I said, just be prepared to come in for the September month here as we wrap up August for some increased volatility and really get those volumes back up. We believe that's right around the corner with traders coming back in from these summer sessions and their summer vacations, and that'll certainly create opportunity for us here to present good risk reward opportunities that we want to be having our hand in. So any questions, feel free to reach out to us here. But again, thank you for your time, and we'll talk to you next week.